Hello and welcome to Bondcast, the podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, head of UK rate strategy, and I'm joined today by our global market specialists, Giles Gale and Jan Nevruzi. Okay, in a week where the Bank of Canada and the RBA follow the Norges Bank in pausing and then hiking, I think it's probably best to start with the Fed. Looking ahead to their meeting next week, there's been a whole lot of discussion about this kind of pause, hike, pause shift that might be taking place. I know we've discussed it a little bit on the pod over the last couple of weeks, but it feels like things are moving quickly. So Jan, perhaps you can just update us on your views, what we should be looking for and what you expect from the Fed next week.
So we're actually looking for a no hike again in June. Well, not again for the first time in June, for the Fed to not hike, kind of shift away from the hike in every meeting type of behavior. And it really is on the back of some Fed officials communicating that message pretty clearly before they entered their blackout period. You had Governor Jefferson, who was on his way to become the vice chair, kind of mentioned that it's okay to take stock of the lags in monetary policy and see how these things are going. That's just, we've tightened enough, and we're substantially restrictive territory. See how data will evolve from here. And by the time, if they decide to go again, it could be in July. So that doesn't mean that they're done forever, but more so leave themselves optionality. So like I said, we don't expect a rate hike at this meeting. However, we could see any form of signaling of uncertainty to come through the so-called dot plot, what the Fed uses to forecast where they see rates for the next 3 years in the long run. And in this case, June, they do it every quarter of the meeting. So June is the one where we would get the new set. We think there's some room for an additional upside risk in the dot plot, where they would signal, well, maybe another hike for this year, thus preserving optionality and still leaving July in play. We still don't think July would come with a hike, but it definitely helps out the more hawkish camp within the Fed, who most likely want to go at this meeting. But in our view, as I mentioned in previous episodes too, that we see the hiking cycle as being over, and the next move is more likely to be a cut than a hike. And one final thing that we've been hearing a decent amount after this week, you had the Reserve Bank of Australia and the Bank of Canada hiking in a somewhat surprising way, which was not really fully priced in by markets. And we've had these conversations whether that means that the Fed can come in and do the same thing, as market pricing for the Fed is still below 50%. So implying that majority of participants in that market don't really anticipate a Fed hike. And our answer is pretty straightforward, like it's been in the past when Bank of Canada ramped up the pace of hikes, or when they made changes that didn't really spill over into the Fed, is that while the rest of the central banks tend to be dependent on what the U.S. monetary policy is and how the U.S. economy develops, the Fed, it doesn't work the other way around. The Fed is independent of like the so-called like smaller central banks' decisions, and it's a one-way street. So I don't think anything that we saw, the surprise that we saw from this week, would translate into Fed having to surprise as well.
So before the Fed, though, we obviously have the long-awaited inflation print. How are you thinking about that influencing their decision? And I suppose, like, how strong then do you think that needs to be for that to kind of tip the balance in favor of hikes? Or do you think regardless of that one inflation print, it's they're not reacting to spot inflation and it's just so it doesn't matter? How are you thinking about that?
So just to give you a rundown of what we're expecting, we see the headline number to have edged up by 0.2 in May after 0.4. As you will see, this weakness is that we've seen over the past months in energy markets filling into the headline measure. That will somewhat be offset by higher food prices and more strength in the core measure. So it's too early to say that we're completely in the clear with inflation, although we think the trend is in the right direction. And when I say core, which excludes the food and energy components, we see that increasing by 0.5 in May, which is a big increase, but again, that's the margin of error there in this period is large, and our unrounded forecast is actually 0.45. So you can see it just rounds up to 5, but it's a firmer gain than what we saw in April. Largely two drivers for that. First, we see a little bit of strength in travel-related services like lodging away from home and airfares. And second, based on what we've seen in kind of alternative data providers, we think we will get a second straight month of strength in vehicle prices, which would boost the underlying core measure for this month as well. Some of those will reverse going forward, we think, but 0.45 is our core expectation. So core goods prices within that index increased by 0.6, while services side stay flat at 0.4. On a year-on-year basis, which probably is the number that gets picked up by a lot of media as well. The headline CPI will slide if it comes in line with our monthly expectations. The headline number will slide to something like 4.1 from 4.9, as a lot of these so-called base effects, such as a 0.9 reading from last year, falls out of the calculation of the previous 12 months. And the core CPI should tick down to 5.4 from 5.5, so pretty close to unchanged. What does that all mean for the Fed? We don't think, even with our above consensus estimate for core CPI, and when I say above consensus, it's very close to being in line because of the rounding issue. But we don't think if we get anything like we expect, it will be enough to tip the scales for another hike for the Fed next week. So we think it needs to be an acceleration from even what we have, and in categories that we really kind of have been seeing as flatlining or decelerating. So even if you get like a one-off increase from a higher adjustment in shelter, such as like OE, like the owner equivalent rent and rent measures, I don't think that's going to be enough to push the Fed into a hike, at least for June.
Okay, so positives. Right, let's talk about the ECB then, whilst we're on central banks and inflation. I know we talked a lot about the inflation outlook in the euro area last week after we had that downside surprise in the numbers. Where does that leave the ECB then? Is it one more hike and done, Giles, do you think, next week?
That is our base case. Yes, that's what we've been calling for. And as I hope I said last week, I think that has been tracking reasonably well since we had that better inflation data for May. I guess the week before last, wasn't it? So that's definitely the way that we're seeing it. I mean, look, the risks are on the upside. There's no question about that. So I don't think anyone would be shocked. We certainly wouldn't be if we had a follow-on hike in July to take us up to 375. And to be quite honest with you, I think you could also have that rate rise later on in the year. So I think one thing that we've started talking about and hearing about in the US is this possibility that maybe we have a skip rather than a pause, and that's that's the way that the rhetoric sort of shifts. And I think that's something that I wouldn't be all that surprised to start hearing about in Europe either. Because in any case, I think the other elements that we're looking for from the ECB next week are how do they frame the forward guidance? And of course, it's very light forward guidance. The main forward guidance, of course, is everything is data dependent from here on in, but nonetheless, we'll give you a steer on how we think that the data might look, and therefore, and if it comes in as we expect, then maybe we've got another rate rise or another 2 rate rises still to come. And so that's more or less how we see the guidance coming out of the press conference. So we don't agree with it. We actually think that the data will be a little bit more supportive of lower inflation than they seem to be expecting. But I also think that can change a little bit, because the forecast round is also obviously very important. In fact, I'd say it's probably in many ways the most important thing that we'll get out of next week's meeting. And I say that because we haven't really been hearing very much that's particularly new from ECB speakers in some time, to be honest with you. I mean, lines are broadly drawn between hawks and doves, although there has been a little bit of a shift from some key hawks a very, very small shift in a dovish direction just recently. But it's really with these big forecast events that these things can start to change. And I think that what we'll see is that will change the way that everybody thinks about the ECB for the rest of the summer, essentially, certainly for July. And there we are looking for inflation forecasts to be revised down. And in fact, Giovanni, who's been looking at this much more carefully than me, he's a European economist, of course, and sometimes cameos on this on the podcast when I'm unable. He actually is optimistic that we may even see the projections for 2025 at the end of 2025 dipping below 2%, and of course that would be a reasonably dovish signal as well.
So thinking a bit more broadly then, we've talked about on this pod about TLTRO and QE/QT and the implications that has on spreads, but you've been looking more closely this week at BTPs, Italian bonds, and how they tend to perform over the summer. How are you thinking about that spread to bonds now?
So great news for everyone. We're quite positive still on Italy, so actually no change whatsoever in our bias. Look, I mean, Italian spreads have been really quite tightly range bound basically all year. I mean, 10-year spreads to Germany have been 200 to 175 over or something like that. So, broadly speaking, that has done okay. You've just harvested the carry. And so we were really just thinking about, okay, so, where are we? Let's take stock halfway through the year. What could push us out of that range one way or the other in particular? And and actually when we started writing, we were at the very, very bottom of that range. Italy had really done very well. And as we wrote, and as so often happened, it started underperforming pretty impressively. And so now it's kind of more towards the middle of that range. And it's interesting that was largely, it seems, about a supply concession associated with Spain, but I think we'll come back to that. But basically, that puts us back at levels that we think are reasonably attractive. And just sort of weighing up the pros and the cons. I mean, on the good side, the news out of Italy this week was that there is a very, very deep and willing pool of retail savings, household savings really, that can be mined by the Italian government and is being mined pretty effectively. So they launched this BTP Valore, which I think was above 15 billion for the books are open for several days. It'll probably continue to grow. And so their funding progress is very good. They built up a pretty decent overfund for where they are this year, and I think that basically gives them quite a lot of protection against being fully exposed to quantitative tightening in the second half of the year. Because really on the negatives, I mean, the only things that we really identify as clearly somewhat negative are that up until now they've been essentially protected from quantitative tightening. QT hasn't really existed so far for Italy, and that won't be sustained for the rest of the year. So arguably they do need a little bit of an overfund to be able to go into that with confidence. And the other is TLTRO3 repayment, and I can't actually even remember if we spoke about this on the podcast last week. We did.
Yeah.
I would hate to bore everyone with that one again.
But look, I just remember.
Avid listeners then will remember, I'm sure, that we weren't actually all that worried about that as a theme for Italian credit. And so the fact that I'm highlighting that as one of the negatives, just gives you the steer that that's not something, that we're not particularly worried. And for us, really, the rule has always been, unless you've got something pretty obvious that you're worried about when it comes to Italy, the default is that you just go long, because others to carry. And I think that is doubly so, as we're looking for volatility to come off. It's a pretty good moment in general for sort of credit sentiment and risk sentiment anyway. We've seen lots and lots of evidence ongoing for that. And finally, the seasonals. Italy has a pretty solid track record of doing well in June and July. In fact, the only month in the last sort of 7 years or so that it didn't do quite well in June or July was last July, when we were panicking about the gas crisis.
We'll give them a bit of grace then. Yeah, I mean, I think it's certainly from a UK perspective, it's been interesting this week watching the build up of that BTP Valore book and thinking about potential lessons that could be learned from over here. And on that note, then, the other theme that we've been talking about for a long time on this pod and in person, I think we've bored everybody with it, but it's come to fruition a little bit this week, is the supply outlook. We've had a very heavy supply week in Europe. Was that heavier than you were expecting? And is that what's been driving a bit of the underperformance?
It seems like, I'm sorry, I was just smirking because I thought of a great title, channeling the Gypsy Kings about Valore. Whatever. Okay, fine. So,
save that one.
I'll save that one and surprise everyone with it. So, yeah, it seems like it. Certainly midweek, when we had syndications from the French, there was a 15-year linker, and there was a 10-year Spanish deal, which grew way beyond anyone's wildest dreams. I think it was a very big book, so there was demand to back it, but it was, they filled a lot more, I think, than people had in mind. And that seemed, broadly speaking, I mean, we have had, well, I mean, the other one, of course, alongside when we had EU, we had this BTP issue as well. And we actually had quite a lot of sort of feverish inquiry about whether it was the biggest supply week ever or something, and it's not even by a long way. But nonetheless, it was pretty big. And I think the takeaway there is there's demand for spread, and there has been, we've seen that week in, week out for much of this year. But it seems to me like there's more demand for spread than there is for duration. So it seems like this is being taken down against hedges, and therefore it goes into the market, and it's and we're seeing these concessions outright. And I think that for me is really the pattern for the rest of the year. I've been repeating it lots. I think that demand for duration in Europe is not all that it's been cracked up to be. So that's all I want to say about that. Should we go to you and talk about the UK? I guess that we saw some flattening this week in outperformance cross market of Longend gilts, which got everybody very excited that maybe this was the first sign that LDI was coming back, and of course that would be a super big deal. Tell us about that.
Yeah, we did have a little bit of excitement, although as we record this, gilts are back to underperforming and the curve is steepening again. So I think it was perhaps short-lived and premature. I think we did see little pockets of demand, and like you say, we saw that flattening of the curve, and we saw that happening into the close, which tends to make people think that's LDI coming through. But where there was little pockets of demand into illiquid markets that were driving bigger than usual moves, I think. And then you have other sectors of the market perhaps getting excited that LDI were coming back and driving the market more than those initial LDI flows were. I think that we all maybe wrapped ourselves up into a little bit of a frenzy there. And actually, probably what we were really seeing was a little bit of long end demand now that the 53s auction that we had earlier this week was out the way. And, we all know, because it's been very well telegraphed now, but July is going to be pretty heavy when it it comes to long end supply. We've got 2 longs, 2 mediums, and the linker auction as well. And then likely, we don't have the calendar yet for the APF, for the Bank of England's quantitative tightening operations, but there will likely be, at least one, I suppose, of sort of medium or long sales coming from them. So perhaps it was just a bit more of an opportunity to go long ahead of July when plenty of supply will be coming, because there is a little bit of a quiet period. But I think the short answer is that no, LDI aren't really back yet, and we should not get overly excited about any flattening in the gilt curve.
What a shame. All right, well, I guess the other thing, you've been the lady who lunches and breakfasts and dinners and basically talks non-stop all day and speaking to lots of clients. What is everybody talking about?
We've been seeing a whole range of clients from different parts of the market. I think, unsurprisingly, we talked a lot about the Bank of England. For once, there, to me, didn't seem to be a real clear consensus around what people were expecting in terms of terminal rate. I think everyone thought that more rate hikes were coming, but no one really pushed back that much on the idea that they might go to 5, nor that they might go to 5.5. 5 is our sort of base case, and 5.5 is our upside risk scenario and more in line with market pricing, but didn't feel like anybody really wanted to fade that market pricing in either direction, to be honest with you. We didn't get a huge wave of calls that it was going to 6% or higher, but equally no one thought they were done here. I think the more interesting conversation that we had with almost everyone was the likelihood that they do more than 25 basis points at the June meeting, 50 or more, some people were saying, but I think really the debate will be 25 or 50. Our take on that is that it's probably unlikely. I think you can easily see votes from more hawkish members of the MPC for 50, certainly Mann, maybe Haskell, maybe Ramsden, but getting a majority there, I think, is going to be tough. Not least because I think, for an MPC that, or certainly a governor that feels under a lot of political pressure, perhaps doing 50 now sort of admits, that you were wrong really about how much tightening actually needed to be delivered over the last couple of months. I think it perhaps looks a little bit panicked and a bit of an overreaction to just, albeit it was an outsized beat on core inflation, but, that they shouldn't really be reacting to core inflation. And there is this lag, or spot core inflation, I should be saying. There is this lag transmission mechanism, which is kind of well understood and well telegraphed, but doing more, a more forceful reaction now, doing 50 now, doesn't necessarily speed up that lag. And actually you kind of risk over tightening and then not being able to undo that particularly quickly, because the same lags that work on the way up are obviously also in place on the way down. So I don't think many people really thought that they would do 50. It didn't feel like that was consensus, and that's certainly not reflected in market pricing. But we definitely did have that discussion a lot, is why don't they just do more now? Maybe they want to wait for the the August NPR, where they kind of refresh their models and they can really understand, how persistent these inflationary pressures are, and that will give them a better steer on whether they need to kind of be more forceful in their reaction function. But that was the kind of main Bank of England discussion, I would say. On gilts, I think a few weeks ago, certainly prior to the inflation print, there was a general consensus, definitely amongst the fast money community, that the underperformance in gilts had gone far enough, certainly on a cross-market basis. I think lots of people we spoke to were looking to kind of fade that underperformance or that cheapness. And I think that consensus has shifted now. I think lots of people are on board with the idea that actually there could be further underperformance, and this kind of heavy supply outlook that we've talked about a lot against a lack of demand will still weigh. I think probably the two major points of discussion when it came to gilts and this sort of supply demand outlook were what brings the natural buyers back. So going back to us talking about LDI and when do they feel like gilts are cheap enough. And I think we spoke about this at length last week and probably the week before, so I won't repeat it too much, but my thinking is that this isn't about necessarily a level at which they're looking to for gilts to be what they consider cheap enough. I mean, they've been loading up on gilts since they were 300 basis points or less or more lower in yield. So it's hard to argue that gilt, 30-year gilts north of 4.5 don't look attractive to them. But I think that this is more about their confidence that inflation is on a kind of sufficiently downward trajectory, and that we're kind of close to a peak in bank rate. And until we see that, I don't think that you see those kind of natural buyers in terms of LDI returning. I think that perhaps they return at relatively lower yield levels than overseas investors, but I think we've still got some time before they come back in a meaningful way. And even when they come back, their demand might not be what it ever once was. So they might not be that kind of downward force on ultra long and long end gilts that we've sort of been used to them being really over the past decade. And then the other thing with regard to supply, was, and I suppose Bank of England related too, was just around QT. Lots of questions, I thought quite surprisingly, around, how long does this continue for? Are they thinking about stopping? And I guess that question is a little bit two-pronged, because you obviously have QT, which adds to already high supply risks, but it's a kind of double whammy of adding, because there's the cost of QT as well, and that cost is absorbed by the Treasury. So the Bank of England is selling these bonds at a loss, and that loss is ultimately kind of absorbed into the public finance equation. So, perhaps people were thinking about, in an environment of high supply, and risks of significantly higher yields, what are the Bank of England looking at to think that they might stop QT? And really, in short, I don't think we're anywhere close to that. They've been quite clear that they think that the flow impact of QT has been very limited up until now. It wasn't that long ago that Ramsden was in front of the Treasury Select Committee suggesting that the overall rundown in the stock could increase slightly next year. And they've been clear that it's a kind of market dysfunctioning triggers that would cause them to stop QT rather than anything else. And, to the extent that they're doing QT because they were potentially under a little bit of political pressure, that, QE was clearly thought of creating a lot of the inflationary problems that we have today. So doing the reverse will help bring down inflation. Well, pausing or slowing on sales won't help that. But also, to the extent that they're doing QT because, they want to have some dry powder for the next downturn, again, pausing or slowing on sales won't really help there. So it's not my base case at all, really, that we get much of a shift on QT. We will get the calendar for the next quarter of auctions in a couple of weeks, but I don't think we can read too much into that for the kind of pace of QT or active sales beyond September. That's a separate discussion that will happen over the summer, but it's not my base case that they kind of adjust that meaningfully at all, really.
Okay. And I suppose we haven't had all that much new information actually in the UK in a little while, but next week we have quite a bit of data, notably the labour market data. Maybe you could just give us a quick outline for what you're looking for there.
Yeah, I think not all that much data is a bit of an overstatement. It's been a pretty boring week. No data, no central bank speakers, but like you say, labour market data next week will be closely watched. I guess the two things we'll be watching most closely will be with regard to the employment data. That was kind of what was indicating or starting to show signs of weakness in the labour market data in last month's print. So we'll be looking at the extent to which that PAYE number, which showed a really unexpected drop last month of 136k, to the extent to which that's either revised, because that series is prone to revisions, but B, then sustained into this month. Was that really the kind of start of a downturn, or was that just a data error, essentially, given that it was a big surprise to the downside? And then B, we'll be looking at the labour force survey measure, because that showed a kind of divergence from the PAYE trends, which showed employment gains, but actually that kind of headline number that showed employment gains masked the underlying trends of weakness, which was a shift away from full-time employment and towards part-time employment, which again is a kind of indicator of of some easing in the labour market. So just watching out for either of those trends having either continued or reversed this month. Obviously, the market focus will, of course, be on the average weekly earnings data, where we see a slight uptick in wage inflation again, but you probably expect the kind of underlying employment data or the wage inflation data to lag the employment data. So to the extent that we see a continued sign of weakness in the employment data, that might give the Bank of England a little bit of comfort that those labour market indicators are turning. Anyway, that's enough for me. I think I said labour and employment and wages way too many times in that answer. So let's wrap it up there. We'll catch up next week after the ECB and the Fed, and of course we'll preview the Bank of England because that will follow. So lots to get on with between now and then, and I will see you both next week. Thanks to our listeners for listening in. A reminder, if you like today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks, see you next week.